Welcome to the Deep Dive. Today we're getting into mutual funds. What are they, really? How do they work? And maybe the big question, should you actually care?
We're leaning heavily on John Bogle's common sense on mutual funds, maybe a little peek at Graham and Dodd, too.
Right, Bogle's perspective is crucial here. Founder of Vanguard, the guy behind the first index fund. He wasn't just commenting, he changed the whole industry.
He definitely saw things differently, perhaps things the industry preferred not to focus on back then.
Okay, so let's start simple. A mutual fund.
Right.
What is it at its core for someone, putting their money in?
Well, the basic idea is straightforward. Lots of people pool their money together.
Okay.
And that pool is used to buy a whole bunch of securities. Could be stocks, bonds, depends on the fund's objective. You get professional management, diversification, things that are maybe harder to achieve on your own.
And Bogle, way back in his thesis in '51, he had this hope, right, that funds would bring this sort of sophisticated long-term thinking to average investors.
That was definitely the ideal. But the reality he describes later, it kind of strayed. The focus shifted, maybe more towards short-term moves, speculation, and importantly, the fund companies making profits.
So less about the investor's long-term success and more about...
More about marketing the funds, gathering assets, and, collecting fees. Which leads us right into Bogle's big critique.
The tyranny of costs, he calls it that, and it sounds pretty dramatic. Is it really that bad?
It's central to his whole argument. Costs aren't just a minor detail, they're like the biggest hurdle. They eat away at your returns relentlessly.
Okay, break that down. What kind of costs are we talking about?
Well, you've got the fund's own expenses. Think manager salaries, administrative stuff. For equity funds, he points out this often averages around, say, 100 basis points. That's 1% a year gone.
1%. Okay.
Okay.
But that's not all, is it?
No, not at all. Then there's the cost of trading within the fund. Buying and selling stocks isn't free. He estimates maybe 0.8% of the value per transaction.
So hang on. If a fund manager is trading a lot, maybe turns over the whole portfolio in a year, 100% turnover.
Exactly. You effectively double that trading cost impact for the year. That's another 1.6% penalty, potentially.
Wow. So add that 1.6% trading drag to the expense ratio, which you said averaged around 1.5% in his analysis.
You're easily looking at over 3% of your potential return. Just poof, gone into costs every single year.
Over 3%. That's a massive slice of any market gain and compounded over decades. The book shows that, right? A small leak sinks a great ship, essentially.
Absolutely. It's compounding working against the investor. And this cost reality is, well, it's why the active versus index debate is so critical.
Right. Active managers. They're the ones trying to pick the winning stocks, time the market, trying to beat the average after those costs.
That's the goal. But Bogle's data, and lots of data since, shows it's incredibly hard. Most don't consistently overcome those high costs.
Why is it so tough? Just the fees.
Fees are a huge part. But also, high turnover creates tax issues if you hold the fund in a taxable account. And ironically, if a fund gets really big and successful, it becomes harder for the manager to make meaningful bets without moving the market. It limits their options.
So the odds are kind of stacked against most active funds delivering superior results after you account for everything.
That's the argument, yeah. Which brings us to indexing, the thing Bogle basically invented for the masses.
Index funds. They don't try to beat the market, they just track it, like the S&P 500.
Precisely. The goal is simply to match the return of a specific market index. No stock picking, no market timing.
And the magic ingredient, according to the book, is...
costs. It always comes back to costs. Index funds just inherently have much lower expenses because they're not paying star managers huge sums or trading constantly. Plus, the analysis showed broad market indexes, and thus the funds tracking them tend to be less risky than many active funds.
Makes sense. Even famous stock pickers sometimes say most people should just index, right?
Yeah, you see quotes from people like Peter Lynch or Charles Schwab basically saying indexing is the way to go for the average investor.
Okay, but then there are ETFs, exchange-traded funds. They seem similar, often tracking indexes too. How do they fit in?
They are similar, another way to pool money, but Bogle's analysis points out some differences or maybe potential pitfalls.
Such as?
Well, while some ETFs are very low cost, others, especially maybe more niche ones, can have expense ratios higher than a traditional super plain index fund, maybe 0.5% versus, say, 0.1%.
Okay, still potentially low, but higher than the absolute cheapest index funds.
Right, but the bigger warning Bogle highlighted was about investor behavior. Because you can trade ETFs all day long like stocks.
Oh, I see where this is going. People try to time the market with their ETFs.
Exactly. And the data he looked at was pretty shocking. Investors in some ETFs were lagging the fund's own performance by something like 4.2% per year over 5 years. They were hurting themselves with poorly timed trades.
Wow, so the structure-enabled behavior that wiped out way more than just the fees?
Precisely. The trading friction and bad timing overwhelmed the product's potential benefits for those investors.
So, wrapping this up, why should someone listening right now really care about all these distinctions? Mutual funds, costs, active, index, ETFs.
Because fundamentally, it's about your money and your future.
Right.
Understanding this stuff directly impacts how much wealth you actually build over the long haul. Ignoring costs, choosing complex strategies unnecessarily, it can seriously derail your financial goals.
Really brings home Bogle's philosophy he wrote about, doesn't it? This idea of treating investors like actual human beings, being stewards of their money, not just profit centers.
Yes. And his push for simplicity. Keep it simple, keep costs low, focus on the long term. He argued that simplicity reduces the chaos and disorder the financial industry can sometimes introduce.
So the final thought for you listening. Considering how dramatically costs and structure can impact your returns, as laid out here, how closely you're looking at the fees and the basic setup of your own investments, is that simplicity Bogle championed maybe the smartest approach of all?